Management wants to show you the shiny 18.7% return on equity, but our forensic audit reveals a massive 11.3% gap dragging on your capital. For a retiree holding this for income, that hidden reality changes everything. I have been tracking KEPPEL'S transition for some time now. The single figure that finally made me sit down and run the full dataset was that glaring 82% group gearing. This is the kind of deep dive where the headline numbers look like a celebration. The actual foundation tells a very different story. Opening your latest dividend statement, the headlines hit you with pure optimism. Net profit is up 39%. The dividend payout has surged 38%. Management is proudly calling this a strong performance for the new KEPPEL. But if you are holding this counter for your retirement income, you cannot afford to just read the bold print. Our forensic audit reveals a stark disparity between this marketed sanctuary and the legacy debt wall looming in the background. We need to bridge the gap between what is being celebrated and what is actually happening on the balance sheet. KEPPEL'S transition into a global alternative asset manager focuses heavily on energy transition and digitalization. In financial year 2025, asset management net profit rose 15% year-on-year to $189 million. Sponsor stakes and co-investments contributed $323 million in net profit, plus approximately $400 million in distributions. For a 55-year-old investor using SRS, this shift toward fee-based income is the core thesis. Funds under management hit $95 billion, but here is what the numbers reveal when you look past the headline. While the new KEPPEL return on equity is 18.7%, including the non-core portfolio collapses the total return to just 7.4%. That 11.3% gap is the legacy drag on your capital efficiency. The infrastructure division stands out as the record pillar for the group. Recurring income has grown at a solid 51% compound annual growth rate from financial year 2021, reaching $703 million in financial year 2025. The integrated power business earnings before interest, taxes, depreciation, and amortization came in at $661 million, showing real resilience despite softening spark spreads. Spark spreads refer to the difference between the market price of electricity and its fuel cost. Think of it like a chicken rice stall owner hedging the cost of poultry to keep profit margins steady, even when wholesale gas prices spike. The infrastructure engine is working. The structural problem is hiding behind it. Management spent very little time discussing the discontinued operations' impact on the total group return on equity, which stands at a dismal 7.4%. While the new KEPPEL 18.7% return looks like a sleek MRT train, the legacy assets are the faulty tracks dragging the entire system down. The absolute silence on the specific timeline for the $13.5 billion non-core liquidation is the most significant risk staring us in the face. If these assets do not move, your special dividends stop being special and start looking like a return of your own capital. The fluff is the 18.7%. The forensic reality is the 7.4%. Tracking the monetization wall, asset sales announced in 2025 reached $2.9 billion. That brings the total announced monetization to $14.5 billion since the program began in October 2020. This is a massive number. The divestment engine really accelerated after the $4.7 billion offshore and marine divestment in 2023. Which brings us to the critical watch item right now, the $1.3 billion proposed sale of M1's telco business, still awaiting approval from the Infocom Media Development Authority. That timeline dictates your cash flow. Your income is now explicitly tied to management's ability to find buyers for old assets. Compared to Sembcorp Industries, which has pivoted much more aggressively to renewables, KEPPEL remains more diversified but carries significantly higher legacy baggage. Consider a simple forward scenario, a 10% delay in the M1 sale or other commercial project divestments. That would stall approximately $290 million in anticipated cash flow, potentially reducing the special dividend payout by 1 cent per share. For a retiree relying on the special dividend, this is the literal difference between receiving a bonus and suffering a flat yield. This brings us to the yield floor test, and the numbers here are sobering. Strip away the special dividend, and KEPPEL'S ordinary dividend yield is just 2.8% at current prices. That figure sits well below the 3.2% forensic floor. The forensic floor is the absolute minimum threshold I apply to determine whether an asset even qualifies for serious consideration as a retirement income holding. The headline 47-cent total dividend only clears that 3.2% mark because of one-off asset sale proceeds. That is not a sanctuary yield you can depend on. That is a monetization-dependent yield with a 2030 expiry date attached. For this forensic audit, I apply a conservative floor of 3.2% because I audit for the storm, not just the sunny day. While the T-bill might sit lower today, I do not lower my standards to match a temporary market dip. My floor remains firm to ensure sanctuary assets can withstand a return to long-term average interest rates. When we add 150 basis points of mandatory risk premium to that floor, our minimum yield hurdle becomes 4.7%. Keppel's financial year 2025 trailing yield is roughly 3.9%. That definitively fails the 4.7% hurdle. Breaking down the core metrics, the ordinary dividend remained flat at 34 cents, giving us that failing yield. The special dividend came in at 13 cents, which passes the immediate payout expectation. Funds under management growth is a bright spot, expanding by 8% to $95 billion, aligning with the 10% target trajectory. Core net profit is also strong, up 39% to $1.1 billion, easily clearing the 15% benchmark. The growth engine is working, the base dividend is not keeping up, and here is the debt reality that requires your full attention. Management presents net debt to earnings before interest, taxes, depreciation, and amortization as their preferred internal measure, giving a clean 2.0 times multiple. But look at the group gearing. It sits at a massive 82%. That is a hard fail against our 35% threshold. This 82% figure captures the full balance sheet, including all those legacy assets still sitting around awaiting buyers. Do not ignore this metric. The interest coverage ratio remains stable at 4.0 times, but that gearing is exactly what your CPF money is actually exposed to until those old assets are finally sold. Mapping out the forward scenarios, our base case holds a 60% probability, continued 8 to 10% funds under management growth, sustaining the 34-cent ordinary dividend and providing inflation-matching income. Our bear case carries a 25% probability, triggered if the M1 sale gets blocked by regulators, a $1.3 billion monetization gap, leading to special dividend cuts and share price drag. The bull case, with just a 15% probability, relies on hitting the $200 billion funds under management target early, driving significant return on equity expansion. Looking at forward risks, the Middle East conflict remains a key watch item. Gas supply for the integrated power business is sourced primarily through piped natural gas from Malaysia, alongside some international liquefied natural gas cargoes. Approximately two-thirds of electricity contracts are long-term and hedged, which provides some insulation. Management explicitly noted at the annual general meeting that any prolonged disruption to gas supply could have significant impacts on Singapore and on Keppel directly. If you are tracking the infrastructure earnings thesis to support your yield, the next crucial data point will be the first quarter 2026 business update. Management has earned forensic credibility on the new Keppel operations, specifically within infrastructure, but they are playing a very dangerous game of two Keppels. They want you to value them as a global asset manager like Blackstone, high multiple, fee-based, capital light. The balance sheet is still acting like an old shipyard, high debt, massive legacy drag, and a divestment program running all the way to 2030. The 82% group gearing is a structural red flag that the marketing slides conveniently ignore. Management is effectively selling you a Ferrari engine bolted inside a vintage lorry chassis. My forensic stance puts this firmly in watchlist territory. The 38% dividend hike is entirely dependent on one-off asset sales. Without that special dividend, the yield is a mediocre 2.8%, firmly below the risk-free floor of the CPF ordinary account. Yes, the infrastructure thesis is real, and the funds under management growth trajectory is highly credible. But you are being asked to hold a 2030 narrative while sitting on an 82% geared balance sheet and a $13.5 billion non-core portfolio that desperately needs buyers. Are you really willing to bet your retirement on their ability to sell those assets in a volatile macro environment? When you are managing retirement capital against complex corporate transitions, you cannot afford to read these earnings reports alone. The front page headlines are perfectly designed to soothe you. The real structural risks are buried deep in the supplementary presentations and the balance sheet footnotes. If you are a free subscriber reading this now, you are getting this analysis after the market has already digested the news. Meanwhile, our core community of forensic investors is actively cross-checking the next market setup together in real time before the retail crowd even wakes up. If you want the full forensic picture the moment it is finalized, join Iggy's elite investors. For just $9 a month, you get 0-day access to these institutional-grade cheat sheets before the market opens, so you stop being the exit liquidity for institutional players. This costs less than a kopi and kaya toast set at Raffles Place, but it equips you with the exact analytical tools to protect your capital and spot the red zone breakdowns early. The bottom line right now, you are looking at a garage sale dressed as a global asset manager. Your dividend check is not coming from a highly efficient, capital-light operation. It is coming from a $13.5 billion garage sale that runs until 2030, all trapped inside an 82% geared balance sheet. Keppel only clears the 3.2% yield floor because assets were successfully sold this year, giving a trailing yield of 3.9%. Strip away the special dividend, and you are left with a dangerous 2.8%. Do not misunderstand me. The Bifrost cable and the Sakra cogen plant are genuine critical long-term plays. Good infrastructure absolutely earns its keep. But for a 55-year-old managing hard-earned CPF or SRS money, a true sanctuary asset cannot be conditional on a multi-year divestment pipeline. A construction site with a dividend sign hung outside the fence is still a construction site. If your payout relies on management finding buyers for old oil rigs and telco businesses in a volatile market, that is speculation, not income certainty. That is fundamentally not a sanctuary. This counter belongs firmly on your watch list, but absolutely not in your wallet. Let management prove the $200 billion funds under management thesis first and actually clear that legacy debt before we revisit the yield math. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. When you join Iggy's elite investors using the link in the description, you get past the 7-day embargo window to see these warnings before the crowd does. Protect your capital and stop trading on lagging headlines. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.